Good afternoon, everyone. Welcome to another one of our Wednesday webinars. My name is stockdarts, and as usual, we are going to go ahead and cover the markets. We're going to look at the S&P 500, the NASDAQ, the Dow Jones, and the Russell 2000 like we do every Wednesday. Once we finish with that, we'll take a look at the U.S. dollar, see how it's faring, see how it's affecting oil, gold, and silver, if at all, and see how they're moving. And then, as usual, we'll move on to the chart requests and see if any of you guys that are in here. We have a bit of attendance today. If you guys have a chart request, whether it's a name you are looking to trade or maybe it's a name you already are trading and can't figure out whether you should take profits or stop out if it's going against you, feel free to put it in the chat tab and we'll go ahead and take a look at it during the second half of this webinar. If you like what you see, if you want more information from me, you can always follow me at stockdarts on Twitter. You can find me on YouTube as stockdarts, or you could go visit patreon.com/stockdarts, where I put additional trading content in sort of a blog format. I have a lot of trade ideas on there. Some of it is under subscription, but the subscription's only $8 a month, which I think is pretty good for a lot of the trades that you get. There is free content in there as well as the reposting of the Wednesday webinars. As you guys are aware, Frank is still not around. I still don't have any information for anyone that's looking for that. Hopefully we will get an update, but for the moment I'm just giving the family some space and seeing how things are, hopefully things develop in a better state soon, and I'll get word of how he's doing, but for now, still nothing on that front. Other than that, let's go ahead and get started with a look at the S&P 500 and the SPY ETF. Now, we have actually moved on to all-time highs on the S&P 500 as well as the NASDAQ. So the market continues to chug along and continues to improve. We've been trading under the specter the last couple of weeks of earnings season, as well as this massive resistance level that should be applicable to the markets at the moment, considering we're pushing towards all-time highs and pushing through some significant levels where we really sort of fell last year once we sort of failed to push higher. Today is an FOMC day, right? So we have, for the most part, gone through the major earnings events that we were looking for. Apple, Google, Facebook, Amazon, Netflix, all the big FANG stocks have reported their earnings. Most of them have done well. So the only thing left for us right now is FOMC. Once we see how the tone of the FOMC statement is and see how the market reacts to it, we should have, for the most part, clear skies as far as news and as far as what can impact the markets besides technicals. And I think we'll have a much better gauge of where the market wants to go once we sort of finish this week, and particularly today and tomorrow. And I think from there on, we'll be able to have a better idea of what we can expect out of the markets, not only in May, but in the next couple of months. I still feel like we need some time to test these levels around our all-time highs. But for now, the S&P 500, and particularly what we're seeing out of the NASDAQ, is showing that we might just want to continue rallying. Again, I think that this rally that we've had for this year is getting a bit long in the tooth. I don't think we've had any real sort of test of the bulls. This is something I've harped on for a while. But you have to follow the price action, right? And I think at this point it's the same sort of thing that I've been saying for the last couple of weeks, which is I'm still bullish. I still think the market is doing too good to really doubt, but I don't like the risk reward here, and I don't really like the timing as far as where we are compared to what could happen in the next couple of days or the next week or two. And what I mean by that is, if you just take a look at what we've done over the last month, we've gone pretty much straight up, right? And so at this point, the risk reward is poor, but it's also poor from a timing perspective where the ebb and flow of the normal ebb and flow of markets and the normal going up and down as buyers and sellers continue to sort of take turns going back and forth. Well, the buyers have been in control for a while now, and it's reached a point where even if you buy now and even if it's up 2 weeks from now, it might be down over the next 3 or 4 days, and then you end up being shaken out, even though ultimately you were right about your trade or right about the direction you wanted to go. So I feel like at this point it's still difficult to go ahead and get too aggressive to the long side, but I also think it's not a good idea to try to go ahead and short it because I don't think that we're in a market that's weak enough to short. I think that we should get a pullback, and I'd like to see a pullback, but I don't want to try to guess on a short. Anyone that would have tried to guess on a short over the last month would have been wrong several times over. And eventually it will pull back, right? But that doesn't mean that it's necessarily a good trade to go ahead and try to short this and try to catch a top. I think anyone that does that is getting a little bit too cute with their trading, unless you're a day trader. Right, if you're a day trader, obviously there's plenty of short opportunities every day, but that's a different animal altogether. These Wednesday webinars are usually we're discussing from a swing trader's perspective and from the idea of trading from a holding time of a few days to a couple of weeks, or 3 or 4 weeks at the most. And so in that situation, what we're looking at here is a market that's not really too accommodating right now to playing to the long side or the short side. And so we have to continue doing is we have to look to see where money's rotating, right? Because the market keeps climbing, and there are sectors and areas that are going up little by little as the market goes back and forth through the stage, right? So we have to go and sort of pick and choose, find the names that we like that are not necessarily overbought like the market, not necessarily in a position where they're ready to pull back, and have better, higher probability setups. And then on top of that, we also have to make sure that they aren't reporting earnings, right? And I think now that we've gone through most of the meat of earnings season, right? It was last week and this week, and we've got a couple more days, and there's a lot of names to report today and tomorrow. And once we finish that, we should have a good majority of the names through, and then that way it'll be a little bit easier for us to find swing trades that don't have the specter of earnings above their head, and maybe don't have the same sort of overbought or extended nature of the markets, right? Because a lot of times once you have an earnings event, you'll get a move in one direction or another, and then from there you can go ahead and try to find a better way of trading once you have the chart sort of reset a bit. And that's what we've done in our Patreon page over the last couple of weeks, is find names that have already reported earnings, and we're setting up consolidation patterns after the fact, and we're sort of reset, and we're as extended as the markets. And we've had success both weeks over the last couple of weeks with trades along that vein and along that sort of line of thought. And I think as we conclude this week, and especially once we see what happens with FOMC, we should have a lot more names to be able to trade that are going to have setups that are distinctly different from what we're seeing right now in the markets. But as far as the markets are concerned, if we look at the S&P 500, we have this pattern that's usually not that sustainable, but at the same moment, it can extend further than you would expect, right? So until we see a break of this trend line, we can, for the most part, expect price to just sort of trickle back and forth. I think once it does break this trend line, we're actually now above all-time highs, right? It's not by much, but the major level of resistance slash support wasn't actually the high tick at 293.87. It's really down here somewhere around 292 to 291.70. I think that was really the key support area, and we're really kind of above that. And at this point now, what we want to see is if we do pull back, if you're a bull and you're looking for the next step up in our major bull market, then what you want to see is you want to see a retest of this 292 area and then a move above and beyond it, right? So you see the moving averages. We discussed this concept last Wednesday. The idea of these moving averages, particularly the 20 and the 50, when they're sort of ascending like this at a 45-degree angle parallel to each other, they're like train tracks. And it's sort of broadcasting that the market wants to continue forward. Now, of course, these train tracks eventually cross over. You take a look at what happened last time. We had them sort of moving along in a 45-degree angle for a while, and eventually they do cross over, right? So it's not like because they're moving in that fashion that the market's not going to pull back. Of course it does. For the most part, these things tell you what happened recently, not necessarily broadcasting what happens in the future, but they do indicate that there's a certain amount of momentum or a certain amount of sentiment that is invested in going up, and it usually takes a while for that to die down. I think the momentum has been dying down, but clearly not enough to be able to stall out at these all-time highs. If we look at the levels that we want to watch and sort of outline a couple of different types of scenarios, the first scenario, and I think a very unlikely scenario based off of the fact that we have FOMC today, is that we continue to trickle on upwards along this sort of trajectory. I think that we should expect some volatility today in FOMC, and that should lead to one of two things. Either one, we finally get the reversal, and pull back, or two, we accelerate to the upside, which I think is unsustainable and I would certainly not chase. If we extend to the upside, then more likely than not, the likely thing that's going to happen from there is that we pull right back and either test this ascending trend line once again, or come back and wait for the 20 period and test it again. In that respect, once we get that retest and we get a confirmed bounce, then I think it might be worth playing to the long side. If we do pull back, there's a couple of different ways that we could pull back. And I think the first one would be a shallow retest of the 292 area and the 20 pair moving average. And then this would be the same as if we did sort of an acceleration to the upside and then eventual pullback. Once we get a confirmation of support at this 291.70, 291.80 to 292 area, and we push past it, I think that makes for some good long plays. And we should have a lot of charts to set up for long plays based off of that. However, if the reaction to FOMC is not good and we do lose this 292 area, then it comes down to where exactly we pull back to. And I think that there's a level down here around 285 to 286. I don't expect us to push past that because that will be around the 50 pair moving average, and it will be right around here, which is where we started this sort of trickle up. It would be a full retracement of that, and I would expect a lot of buyers to be stepping in there. A lot of what I said last week again applies, and that is that I think, personally, it would be a good thing for us to spend a bit more time in this area, rather than just kind of slice right through highs. I know it's sort of counterintuitive. You would expect that if you're bullish, you just want the market to always go up. But I feel like sometimes the longer a market goes up without a real retest, the more likely that we will eventually get sort of a swift move to the downside. And then once you catch the market off guard and you catch its participants off guard, there's a lot more room to the downside. And I think that's what happened last year, is we had this market that we started off the year sort of in a volatile fashion going back and forth, but then we had a market that started just climbing steadily, right? And towards the end, it really sort of just kept trickling upwards with no real selling pressure. And once we did have the selling pressure, it was kind of like the dam broke, and we finally got that rush of selling. And it took a long time for that rush of selling to really abate, and it didn't really happen until the start of this year. And then what we've had this year is this amazing rally where we just continue climbing upwards, and there's been zero selling pressure other than maybe a couple of 3-day stints here around the 280 area. And I feel like at this point, the bulls are starting to get a little emboldened again and have not really been tested strongly. And so I feel like if we do get some strong selling pressure, we need to see the bulls not necessarily panic, but at least be faced with the fire of selling and see how they react to it and see whether they have the conviction to continue buying at these levels. At the moment, all we're really seeing is the sellers just are not anywhere to be seen. And so the bulls continue to just hold, and you get a lot of the weaker hands that just are chasing price action upwards because they're fearful of missing out on what they've already missed out, right? And they don't want to miss out on any more. But the truth of the matter is that this move has already been, for the most part, culminated. And I think at this point we want to see a major consolidation of this before we could really get behind looking at a new leg up in this bull market. So, it's a tricky spot, right? Because we're at new highs, we're pushing through those new highs, but overall, really, it's not a good spot to go ahead and try to get too long, just based off of what we're seeing. So, ideally, if you want to go ahead and really get a good long opportunity and good trade setups, you want to see a pullback here. And I think the question is just how far does it pull back before we start to maybe not trust it? And I think there's plenty of room, right? Even if we went all the way down here to 280, I think that that's still indicative of a pretty strong bull trend and just a normal retest of what should be a key area. I think that this 280 area was a major level from last year, particularly during the last quarter of last year. And I think it's really the only area that we've had any kind of real testing. And I think at this point we've conclusively moved above it. So if we came right back down to it, this should be a stable area of support and a place for the bulls to look at going ahead and get invested back to the long side with value and with good risk reward. Anything above it, I think, is still, it could be good risk reward depending on the setup, but we need to see a consolidation pattern emerge before we could consider that as a good area for risk and reward or value. So that's where we stand with the S&P 500. I think we'll get a much clearer picture over the next couple of days once we see how the markets react to FOMC. And for now, I'm still sort of sitting on my hands and taking some small trades here and there, like the ones I post on Patreon, or trading Forex like I mentioned last week, and just waiting for a better opportunity in the markets. I think we should get one pretty soon, or if we don't get a better opportunity, I think we'll finally have some of that selling, and we can sort of step back and wait for a better opportunity once we get a clear sort of pattern to develop. And if we go back and take a look again, and we take a look at the weekly chart and see where we've been and what we've come through, you can see that despite the fact that we actually have inched towards new all-time highs, if you look at this big pattern that we've been developing over the last couple of years, you don't typically go from the bottom to the top and then right through it. Typically, when you have a pattern like this, once you hit those resistance levels, you trap a few sort of optimistic long players that want to go ahead and play the breakout, and then you kind of come back and you sort of set up your next consolidation pattern. If we take a look at what happened the last time we had a major multi-year sort of broad range, which we've sort of had, I mean, we've only really been trading in a broad range for about a year and a half now. But the last time this happened, it took a couple years. And as you can see, we had the nice trend up to it. Then we had the big breakdown. And you'll notice, again, we kind of zoomed right back to it pretty quickly. And then came back and then redid it again. And then ultimately, even though we had a big sort of straight move right up to those the resistance level at 213 or the ceiling of that range, it eventually did lead to a consolidation pattern underneath it before we were able to break out. And the thing I keep pointing out is, if you're fearful of that breakout, I think you have to realize that once you get that breakout, you often get that retest. And then from there, it's a much higher probability play and a much safer play than trying to chase the breakout. Because when you try to chase the breakout, there are times where it fails. It failed here. It didn't really break out there, but ultimately reversed there and ultimately reversed again before it finally was able to break out. And I think the people that are trying to chase these breakouts here are setting themselves up for a position where more likely than not, they're going to get shaken out, even if ultimately the breakout does serve and hold. So for me, I'm still being a little bit patient. I'm still waiting. I've been participating in this rally sort of in a minimal way. You would say maybe you've missed out on a lot if you didn't sort of get aggressive, but really there were only maybe 2 or 3 opportunities to get aggressive so far this year. And I think if you miss those opportunities, you're better off just picking and choosing your names and just taking advantage of the momentum as it moves forward, but not getting overly aggressive. I think the only opportunities we really had to get too aggressive was this consolidation range around 263 and then this nice falling wedge that we had around the 280 level. I think both of those set up really nice long play opportunities. But everything else, it's been mostly just a market that's been drifting upwards and giving people very poor risk reward. And what often happens in these scenarios is when the market is climbing like this straight up, it erases a lot of mistakes, and traders get complacent, and they go ahead and they start chasing the price action because they're not being punished for it, right? And they start to develop bad habits, and then ultimately, like what happened last year, is the market punishes people for it. And the type of punishment that comes from this is the kind that closes trading accounts and puts people right back to basically zero, and then they have to they have to go back to go and start over again. So you want to make sure that you are remaining disciplined and you are paying attention to the rules that you have for trading, because it's really the only thing you can control and the only way to stop yourself from blowing out your trading account. Okay, now again, I think as long as we're above 280, 281, we're good. If we stay above 292 or so, then I think that's really bullish. But I'd like to see a consolidation pattern in that range before I wanted to go ahead and get more aggressive to the long side. Until then, I'll continue to just pick and choose my names. Now, if we take a look at the NASDAQ continues to lead and continues to be the one showing us where the markets want to go. And you can see we've sort of had that consolidation and retest already. Right? We have a bull flag developing. We already had the breakout. We had the acceleration and then the pullback, and are just sort of holding this pattern. And I mentioned this 2 weeks ago, and I'll continue to mention this. As long as this green trend line maintains itself, I think we have to assume that the market wants to continue climbing higher. Once we lose that trend line, then we can sort of figure out what the next step is and how this consolidation pattern is going to develop. Do you want to chase the price action? No, you still don't. I will say this. There are tech names that are not in a situation right now where you'd be chasing. Tech names have set up a bull flag, right? And if you find names that are trading in a bull flag like this and you can trade momentum, then you could trade the momentum to the upside on these names, right? So this is what I was mentioning before about how when a market continues to climb upwards like this, you have to figure out exactly where the money's rotating to and where the momentum is. And for the most part, tech has been leading the way higher, and they've already sort of gone through the breakout, and they are in the process now of retesting and holding above a breakout area. Now, I think, again, we'll figure out with FOMC today a better idea of whether we're ready to push through this bull flag or whether we need more time to really sort of test these all-time highs and maybe test the moving averages. But I think the first place that we're going to get the answer to that will be tech. So this is the area to watch. Don't forget, with FOMC, it's not just what happens at 2:15 today. Typically, there's usually going to be some fluctuation to the response to FOMC. So I'd pay more attention to how we close today and how we open tomorrow. And I think from there we'll get a better gauge as to what's going to happen with the Qs. But as far as what we want to watch, first line of defense is this green trend line and the 20-pair moving average. The next line would be the all-time high area around 187. As long as we stay above 187, I think that's very bullish. And it might mean that we're going to see a continued move up on the S&P 500 and that we'll see the Dow Jones and IWM, which we'll get to in a minute, start to challenge their all-time highs as well. Now, if we do falter, if FOMC, the reaction to FOMC is negative and we start to come down, I would expect some support to step in here at 187, but if we lose that level, I think that there is room to the downside all the way down to about 182, which would be the 50-pair moving average and would also be this area here from which we just broke out of that pennant, as well as a key area from last year, right? So I think that there's a lot of multiple reasons for this area to end up being a good support area, and I would expect it to be a good spot to go ahead and buy the dip, at least for a reactionary play to the upside. There's also another key level, and I think the ultimate level that I'd be concerned with at the moment, which would be 178. As long as we stay above 178 and we trade in that area, I think even a negative reaction and a bad start to the month would not be the end of the world, and I think it would do a good job towards resetting a lot of charts and giving us better risk-reward and better value plays as we move into the summer. And I would only really start to worry about the market if we started to lose this 178 area on the Qs. But for now, as long as, we'll see what happens. We'll see how we react to FOMC. And as long as we stay above 187, I think that's very bullish. If it doesn't, then we have to see how we behave in that area. But again, I don't think that coming back and retesting this is a bad thing. As long as we respond to it positively and it doesn't turn into a situation like the end of last year where instead of retesting, we just continue bleeding downwards. I don't think that's really a scenario that I'd expect going to happen right now. I think like I said before, we haven't had the bulls they haven't been tested yet, and I expect them to buy the next couple of tests. So any pullbacks we get, I think, are going to be buying opportunities, and I think we still need to be bullish. We just need to be patient and disciplined in how we go ahead and approach our plays to the upside. Again, the NASDAQ is setting up a nice bull flag, so if you want to play momentum to the upside, this is probably the area to look at. And if we do falter, keep an eye on the interplay between the 20 and the 50-pair moving average and this area around 182 or the area around 187. Now, if we look at the Dow Jones is in a little bit of a different spot, right? And you can see the Dow Jones, compared to the NASDAQ and compared to the S&P 500, it's still sort of lagging a bit. It is slowly making its way to all-time highs. So overall, it's still bullish. It's still holding above this 262 area, which was kind of important, and is climbing higher. So it's doing bullish things. It's not like it's being negative. It's, for the most part, doing well, but you'll notice that it didn't keep that same trend that the other two have, right? It actually downshifted, and it's still trying to climb higher, but it's already losing momentum, right? So this is giving us a signal that maybe the markets are starting to tire out, because we're starting to see waning momentum in some of the weaker areas first. Whether this can continue or not is still up for debate. A lot of times over the last couple of years, we've had this sort of tug of war between what the stronger areas are doing and what the weaker areas are doing, particularly, of course, what IWM is doing compared to the other two. So it could be that the Dow Jones is starting to slow down. Is starting to slow down the markets, or it could be that the S&P 500 and the Nasdaq are going to try to pull the Dow Jones up with it, right? And I think at the moment that's what's happening. Is the S&P 500 and the Nasdaq are pulling the Dow upwards towards its all-time highs. And as I mentioned last week with the S&P 500, the closer and closer you get to this, the more it acts like a magnet because it needs to be tested. And the closer and closer you get to it, the more that traders that are holding long are waiting for that spot, and the more that the sellers decide to wait to see what happens at that spot, which of course is how that magnet works and how price continues to get attracted towards these key price levels. And so I think at this point, probably inevitable that the Dow Jones comes up and tests the all-time highs. The question is it going to do it in this particular move, or do we need another sort of pullback before it gets enough momentum to come up and test it? And I think it's going to be pretty clear once we see how we react to FOMC today, and I think from there we'll get a better idea. So I think when we meet next Wednesday, we'll have a much better idea of how to go ahead and trade the next couple of months. But for now, we just have to go off of potential scenarios and what we can expect out of them and how we'd react to it, right? So, again, I think if we do come up and push towards all-time highs, I don't think it's really a good pattern to go ahead and buy on the Dow Jones or any names that are mimicking this pattern. Now, you could say, and this is the interesting thing, of course, is that you can always reinterpret price action, right? You could say that this is a bit of a bull flag, in which case you can say, well, we've got a nice bull flag. This is just like the Nasdaq, and it's ready to push forward. And while this could be construed as a nice bull flag off of the move off of this sort of little bull flag. The problem is, if you're trading momentum off of this bull flag, look at what you have left before you hit the critical level of resistance, right? So the risk reward's just not really there, despite the fact that it could be setting up a momentum play to the upside. So I think for the most part, this is still an area that I'm sort of staying away from. I'm not that interested in some of the Dow names or names that are printing flags just below resistance levels at the moment. I think that in order for me to get behind a move like this, I would like to have seen the consolidation range right at resistance rather than just below it, where at the moment a breakout could get kind of messy as it moves towards its all-time highs. I think overall, again, if we look at it from the perspective of what's happened in the intermediate to long term, it's still bullish, right? We've got a nice breakout of this bearish trend that we had last year. We had a nice consolidation and a retest move off of that range and are just climbing upwards, right? So this is all very bullish. It's just a matter of timing right now and waiting for a better opportunity that gives us higher probability setups. And I think that's what we need to wait for, is better opportunities to get good plays to the long side. I think that this little pennant here was okay, just like this channel was earlier in the year. But for the most part, where we are right now, it's a little bit more difficult to trade this to the long side. Now, the final area that we have is IWM, right? And I mentioned this idea last week that if there's an area that needs to play catch-up and where there is potential for long, plays to the upside, it's the small caps. You can see how far we have to go to hit all-time highs, and I don't think that the small caps are really at a spot here where we can say with any kind of real clarity that they're ready to test all-time highs. I think that they've got a long way to go before we can say that they're going to test all-time highs, and I think by the time they do, we're going to see all three of the other indices well above and beyond their highs. However, I think that there is plenty of upside potential here. You can see this big gap that needs to be filled. If we continue to see the other indices push through their highs, I think that there's a lot of room for some explosive potential in some of the small cap names. Now, you'll notice that it's doing a lot of this, and IWM is doing a lot of the same things that the Dow Jones did, right? We have this bearish trend. We were able to break above it, and we're now in the process of sort of confirming that breakout and pushing past our recent highs. Unfortunately, we haven't been able to, right? Even the last couple of days, we've sort of been struggling with that that push past 158 to 159. If we can get past that, I think that there's potential for several points to the upside. And I think we could see some good momentum on IWM. And I think that would happen if we see a good reaction out of FOMC today, and we see sort of the S&P 500 accelerate its move, and we see the NASDAQ sort of break above that bull flag. I think we're going to see a nice move out of the small caps. So this is an area that I'm watching. Are names that are performing like this, that are setting up patterns like this, right, where there's room to the upside. So the risk reward is better than what we're seeing on, say, maybe the S&P 500. And even though they're weaker, they're setting up patterns here that look like they can be at a point where we're getting a sentiment shift and we're getting a nice trend shift where we could get a bull move coming out of them, right? So I like stuff like this right now. Now, that being said, I still think that the tech names and names mimicking what the NASDAQ are doing are the best setups, right? But I think that there aren't many that are doing patterns like that, right? There aren't many that I've seen that are mimicking it, that are setting up bull flags at new all-time highs and setting up momentum plays to the upside. There's really not that many names, despite the fact that the market's up there. I haven't seen too many names that are doing sort of the same thing. So if I don't find names like that, well, the next ones that I'm looking for, the ones that are getting these major trend shifts and have room to play catch-up and are setting up for a good play. Now, that doesn't mean I'm just buying the weakest names. I'm looking for names that are showing constructive price patterns that are indicative of a big sort of trend shift, right? I discussed this idea a while ago, or earlier in today's webinar about the train tracks, right? The moving averages. Well, if you take a look at the 20 and the 50 on IWM, they're now starting to curl upwards and set up the beginning of those sort of train tracks. Now, it might not happen that way, right? A lot of times you have these things start to move up, and you take a look at what happened maybe at this point. They had started to curl upwards, sort of forming train tracks. It ended up not happening, right? It ended up kind of curling right back over. So it's not always indicative of an emerging trend, but we have them right now kind of crossing over the 200, which is what a lot of traders call the golden cross when the 50 crosses over it. And that's usually indicative of a new trend to the upside. I've noticed a lot of times with that pattern, it takes a while before it really emerges. So, take that with a grain of salt right now. But if we can get a move past 158 and above, say, this area, and we're going to extend it all the way, right? That's sort of the next key level. If we can get above that, I think there's a lot of room to the upside. And I think at that point, if we do get that breakout, we'll see the moving averages start to form those train tracks, which could lead to a nice move upwards on IWM. Now, if we do have a poor reaction to FOMC, well, the first place we're going to see it is IWM. So IWM is still a good place for us also to sort of have a good gauge on what's happening in the markets. If we do get a poor reaction, well, then IWM is going to be the first one to break down. And I think the key will be if we lose all three of these moving averages, which I just mentioned are setting up in this nice bullish sort of pattern that's indicative of a new trend. Well, if we lose all those moving averages, then I think it's clear that the trend isn't ready, and we're likely to head pretty quickly down to this 150 area, and then from there we'll see what happens and how the market reacts to that, and how IWM and the small caps react to that area, and whether there are bulls ready to sort of buy these names, or if we're going to see the same pattern that's been happening throughout the last few years, which is that traders quickly abandon the small caps and then sort of throw their money right back into the safe names and wait for the market to sort of make its way upwards with the safe names instead of with the risky names, which I think has been this weird sort of phenomena that's been happening over the last decade, really, where it's a lot of the safer names are the ones that continue upwards, showing that traders are still, even though it's been a strong market, they haven't been that aggressive when it comes to assuming risk. And that's the reason that, for the most part, the IWM has trailed, and the small caps have trailed behind the other indices throughout the last decade or so, is because a lot of traders still have one foot out the door because they're still very fearful of what happened in 2007, 2008, and 2009. But if we do get a little bit more exuberance out of the bulls and we get a little more aggressiveness, then IWM could set up for a nice place. So at the moment, it's still theory. But if we see a nice breakout here, I think that there is potential for some nice catch up on these names, and that's going to be one of the areas that I'll be looking at, and I have been looking at over the last couple of weeks. All right, so that's the four major markets. Like I said, I think a lot hinges on what we see out of FOMC today, and we'll get a much clearer gauge of where the market wants to go next Wednesday, pretty much. And until then, I think we want to wait and see what happens with the markets and see how they react over the next couple of days and see what scenario plays out, whether we get these momentum plays to the upside or whether we need to backtrack and start testing some of these levels of resistance that I just pointed out across the board. I think if we do get a pullback, it's not the end of the world. I think, if anything, that might be better served for the bulls to be able to get nicer opportunities to have better risk reward and have cleaner patterns to trade right now than just trying to chase momentum upwards in a stretched out market. So I personally am actually rooting for a bit of a pullback. I think that it makes it easier for me to trade when I have cleaner setups and cleaner patterns. And I can draw nice little trend lines to give me easier trades to take than just trying to sort of interpret what the price action is doing when it just climbs upwards. All right, so that's the four major markets. Let's take a look at the U.S. dollar. We're going to look at oil, gold, and silver, and then we'll move on to the chart requests. Those of you that are in here, we do have a nice amount of traders in here. A lot of you guys are regulars. Feel free to give me ideas if you're looking what you're looking for. I'd love to see what you guys have in mind and what you guys have been watching. We have an interesting case going on right now in that the U.S. dollar has actually pulled back over the last week, and yet we've seen gold, silver, and oil all pull back as well. So for the most part, they're all pulling back right now, which is usually not the case. For the most part, they're inversely correlated. But we had a very strong breakout on the U.S. dollar over the last couple of weeks, and then it's been pulling back after hitting resistance levels over these last few days. And I think it's heading into FOMC. It's a little curious as to whether this is anticipating further weakness out of whatever we get out of the FOMC, or if this is just a pause before. And I think, again, we're much like what I just mentioned with the markets. We'll get a much easier or more clarity once we see what the FOMC statement is and sort of the tone of what they're saying as far as interest rates are concerned, and whether that's going to indicate more bullishness out of the U.S. dollar or less. I still suspect the U.S. dollar is trending upwards again, and I think that despite this last 3 or 4 day pullback, unless something changes drastically out of the FOMC statement, we should see support here, and we should see a continued move upwards. Now that we've sort of broken past this key level here, this 26 on the UUP index, and this nice pattern that we had developed where we kind of pushed up and then had this real nice channel that we broke out from. So overall, this is anticipating, even though we're bearish in the short term, very short term, I think in the intermediate term, this is setting up into a support area that looks like the U.S. dollar wants to continue bouncing. Now, a big part for that, of course, is what's happened with the euro-U.S. dollar. I mentioned last week the potential for a nice bearish trade on the euro, and that actually played out very well. And despite the bounce that we've had over the last 4 days, that was actually a very good trade that worked out very well for anyone that was into trading Forex or into trading the U.S. dollar. Now, what we have now is, interestingly enough, a move back into this trend that's developed, this bearish trend, and we're kind of setting up right into that area as we hit FOMC. So again, I think that this is critical to see what happens now as we come up and retest this trend shift. And if we can break through it to the upside, then that would obviously indicate more weakness out of the U.S. dollar. Again, this is inverse because it's based off of the euro. So up is good for the euro and bad for the U.S. dollar. And as you can see, the U.S. dollar has been gaining strength over the last few months. But at the moment, we're getting a sort of reactionary move back up from the euro. And more likely than not, I think that it's going to end up being another bearish play where it's just going to continue hitting its head against this trend and continue downwards. But if we do get a breakthrough, then I think that indicates that maybe the U.S. dollar does need more time to sort of pause and retrace more of the move that it just made. At the moment, there are two critical levels of resistance that I'm watching for the euro, and that's this red trend line and this 113 to 114 area, which now should be a massive level of resistance when you look at what it is in the long term and what it sort of represents. So I think overall right now we're seeing the U.S. dollar gain a lot of strength versus the euro. It spent a lot of time here trying to hold that level and failing. And at the moment, I think that, I mean, it did hit a level that I think was critical, was this 111 area. There is more downside, but there is a chance that it tries to maybe break out before it tries to roll over again. So I think for the moment, I'm sort of standing in the sidelines, waiting to see how we play off of this trend line and whether we try to explore this area or whether we continue to roll over. But I think both are still areas that I look at shorting rather than playing to the long side. Now, if we look at the U.S. versus Canadian, we'll see very similar to the UUP index that we had the breakout, and then now we've kind of come back and are in the process of retesting what was resistance that should now be support. Based off of the pattern here, it looks like it might need a little bit more back and forth. But again, I think when you have something as big as an FOMC meeting, they tends to affect currencies pretty strongly. So I think we'll get a better idea of whether this retest is going to confirm over the next couple of days. And at that point, we'll see whether we need to come back and retest 133 or whether we are ready to push forward again and start retesting this 135, 134 area. Overall, this is still bullish, and until it changes, I think this is another indication that the U.S. dollar has more upwards momentum in it and is likely setting up for another move to the upside. And then the one that is a bit different is the U.S. versus the yen, where we can see that the U.S. dollar has definitely lost traction versus the yen. And we had a big reversal about a week ago. And this actually set up a short play on the U.S. dollar. So this is the one chink in the armor as far as the three currency crosses that I like to follow, showing that maybe there is weakness coming in. Now, this, of course, could just be strength out of the yen, and not necessarily that indicative of what the U.S. dollar is doing versus the other currencies. But it is showing some weakness coming in here. So at the moment, I would expect more weakness out of this. Even if we do get another bounce, this is a bearish play here, and looks like it's setting up another one of these moves to the downside to maybe retest 110. Yeah, 110.50 to maybe 110. I think there's still more room to the downside here. So overall, I think the clear patterns for trading currencies were a couple of weeks ago, and I think they set up nice moves. And we're in the process now of sort of confirming those moves and getting the reaction to them. So we could get some momentum plays based off of that, but I think that once we get a better idea of what's happening with FOMC, we'll get a better idea of what the next pattern is on any of these currencies. Now, you'll notice, despite the fact that the US dollar pulled back, gold hasn't really done much, right? It was kind of up at this level last week, and then it sort of just has gone back and forth around this area and hasn't really been able to breach this strong support zone. I think that the only way that it really makes a move up here is, again, based off of FOMC. If the US dollar has a real weak move off of it, then we'll get a strong move out of GLD. And that could set it back up above this 121, at which point we can look at it as maybe a value play. If you take a look at what's happened recently, there is a nice trend line here, but I think we're still a week or two away from really challenging that. So I think for now, the better play really is if we see US dollar strength, then that would indicate that GLD is ready for another breakdown, at which point we could play this as a short for a move back, maybe even all the way down to the 200-period moving average. So there are two scenarios here in play. The bullish one, I think, still needs a little bit more time to develop, but the bearish one could develop real quickly if the US dollar gains strength. And so this is an area you can look at if you're uncomfortable with trading Forex and you're kind of not sure what to do with that US dollar move. Maybe see how it affects gold and silver. Now, interestingly enough, SLV actually already has been breaking down, showing again that it's the weaker of the two precious metals, and it already has lost a pretty significant range and continues to just sort of bleed downwards. I have not been really too interested in SLV in a while, and unless you're really looking at shorting this, I think you're better off just waiting for it to really set up a better pattern than what it's been doing. And then finally, we have oil. Oil finally showed some weakness. Not a lot, but it did show some. We can see we lost the top of that channel and are now kind of smack in this channel again. Still, for the most part, still in a strong trend to the upside, despite the fact that we finally sort of lost a little bit of support here around the 63 and 20 area. it's still, for the most part, bullish in the intermediate to long term. It's just a matter of how this plays out in the short term and how we consolidate here. I think if we get a little bit of another pullback down to the bottom of this channel and around where the 50-period moving average will come up to meet price, I think that this is still a play to the bullish side on oil. But I think for the moment, oil has lost a lot of its upwards momentum and needs a bit more time to sort of stabilize before it's ready to sort of move forward. And I think that's perfectly fine. When you look at the strength of the trend that it's been going through, this sort of mimics a little bit what we're seeing in the markets, right? Where when you have these strong trends that continue to go upwards, eventually you do need them to pull back. And we're starting to see that on oil at the least. And I think maybe it needs a little bit more time to sort of come back and retest some of these areas that it's pushed through. But overall, until it loses this upwards trend, until it loses its 50-period moving average, I think it's still climbing upwards. And it's just a matter of waiting for the right area for that to culminate. So this again looks like an area that we want to just watch and wait for another week or two until it starts to hit better levels of support and starts to form a pattern that's a little bit easier to diagnose than what we're seeing right now. Okay. All right. So that's oil, gold, silver. We're pretty much done with what I like to cover. So if anyone has a chart, I'd love to see what you guys are looking at. Again, we've got a lot of guys in here, a lot of girls. If you guys have something, I'd love to see any names that you guys are looking at and see what you guys have been trading, if anything at all. So no one's trading anything. You guys are all sitting on your hands. A couple of the names that I had pointed out on my Patreon page that have done okay for me have been a couple airlines, and part of that was due to the weakness I saw in oil, right? And so we take a look here. You can see Southwest reported earnings last week, and they tried to break out and then ultimately came back, but they've had a nice constructive move over the last couple of days and have been sort of starting to slowly climb upwards. And then Alaska Air has also had a nice, again, this is sort of what I've been pointing out, sort of similar to what I said about IWM, looking for these names that are getting these trend shifts, and this is a nice trend shift on this name. And it's not up a lot on me for me right now, but it's up a decent amount compared to where I got in and what my risk was on it. And it's doing okay. And so this is sort of an idea of what, sort of a picture of what I'm looking for and what I've been sort of putting up on my Patreon page. And so far, these ideas have worked out pretty decently, as well as the plays from last week. And that's what we really need to be looking for right now is names that aren't as stretched out as what the markets are doing. All right, Denise, you want to look at Triple M. So you have a cash secured put at 187.50. Okay, so was that earnings? April 25th, right? Yeah, so that was obviously, and yeah, this is again points out why I think it's always important to double check earnings before you swing trade during earnings season, because a name like Triple M is usually a pretty easy company. It's a nice quote unquote safe, right? There's really nothing ever safe in the market, but it's one of the easier names as far as it's not a very volatile name, and still look at the massive drop that it had during its earnings, right? So now you're looking at this as a value play. It's a dividend pair, which is nice. It's gotten beat up, and these are the kind of names that usually, if you want to sell puts on, this is the kind of area or the name you want to, because usually, for the most part, these names behave in a pretty decent way. They're not really they're not the biotechs or anything. That being said, we will go back to the long term chart, right? We take a look at the key levels on it. I think those are kind of the key areas that we want to watch, and it's in the middle of that, right? So there is more room to the downside if we're looking at this as a long-term play. If we look at it on the daily chart, sort of the same thing. I like what you. I don't know if you did this yesterday or today, but with yesterday's hammer candle, there was always the hope that it gets bought up again today. We still have 3 hours, and if this ends up being another hammer with a nice wick, then I think this looks pretty good for a move back up to the 195 area. A lot of times when you have these massive gaps, it takes a while, right, for them to work through it. But if you look at the last gap down it had like this, it was pretty quick about moving back into that range. Doesn't happen every earnings report and doesn't happen every gap down, but there is the possibility of this to move back down. But I do think that there is potential for this to come all the way down to 180, 170. A lot of times when I do a play like this, if I want to sell puts on a name like this that I want to acquire some shares, I usually do a small portion here, maybe 25% of what I expect my total position to be, and then wait for a reload as it gets to another level of support. Either way, you're good, but you were hoping to hold. You're hoping for it to hold the 190 range. Yeah. So obviously, off of yesterday, this looked a lot better yesterday, right? So we had off of yesterday, we had that hammer candle, and it's like, oh, that's not too bad, and you would expect it to kind of hold that, but today's candle is pretty bearish, right? But it hasn't lost yesterday's lows yet. So there's always hope that it closes strong today and maybe gives you a better pattern. At the moment, it's not really indicating that, but we can always hope, right? Okay. Yeah. So Denise, yeah, on this one, I don't know. I'm assuming that you still have room to add. I think the major level is 182, but if it can bounce from here, I think it can hold here and then maybe make its way back up here. It's going to take a long time to get past this area, and I don't know. I'm assuming that you're adding this since you just mentioned it's a dividend payer. You want to just add this to your long-term portfolio, and I think that's a good idea. Okay, yeah, then that's fine. I think this is what you want to do. You want to take advantage, and the thing is, when you sell puts, you need to take advantage on down days. So a lot of times I go over this concept about having to you want to see confirmation of support and confirmation of a move before you go ahead and enter a trade. But when you're selling puts and you're selling volatility, you don't, or even if you're selling covered calls, which is what you intend to do with this in the long run, if you want the pure premium on it, you don't always want to wait for confirmation of that move, right? But you have to have a very strict risk management plan in place, and you have to have a way of entering. And so in these scenarios, I like to scale in slowly. That way, if you are wrong, since you're getting in at a very, you're usually getting in at a very ugly time, you want to be able to give yourself room to be able to absorb any additional losses as you try to figure out where the bottom is, right? So in this particular case, I think that was fine what you did, whether it was today or yesterday, because there was a lot of volatility to the downside after the earnings, right? And I think that's when you get the best prices. You thought the drop was over, and that happens. That obviously, when you're trying to catch a knife like this, it often takes several times before it actually bottoms out. So you have to have the right risk reward plan in place, and you have to have the right entry strategy. And I think in these scenarios where you're selling puts, you need to take advantage of the big down days, but you need to also scale in. So I think the next thing is to wait for 182 or to 181, and then go from there. The other thing is, of course, you have to have supreme confidence in your ability to read a chart and in the level that you end up choosing as the area you want to go ahead and sell premium on. Okay. But I think again, I wouldn't, because of what your ultimate goal is on this. I think this is fine, but you may have to add more depending on how it goes here, because I think it's kind of stuck in this 195 to 182 range. Okay. All right, Ray, we're going back to one of your favorites, Freeport McMoran. All right, so you're asking if you think this is a double bottom on the daily. Okay, I don't think this is a double bottom at all, because a double bottom indicates a double bottom, right? It indicates that you're at the bottom of the range and that you're testing that range for the second time. This, and I'm assuming what you mean is this, right? You're asking whether this part here and this part here indicates a double bottom. And I'm going to go ahead and say no, I don't think that is what we're looking at. Because again, to me, a double bottom would be something that occurs at the bottom of a range. So for instance, back here, this was a potential double bottom on Freeport-McMoRan, right? We had a move down to lows, then we had a bounce up, and then we had another move back down to test those lows again, and then a move back above it, right? So this was a potential double bottom that was setting up. Now, ultimately, that double bottom failed, right? And then we ended up getting a bigger pattern that developed, and eventually what we had was almost like an inverse head and shoulders, although it wasn't quite that, but where we had a move down, and then the move below it, and then a move back above and beyond. It's not really an inverse head and shoulders, but it was reminiscent of one, right? And what we have now is different because, again, it's not a double bottom because we're not at the bottom of the range, right? We're retesting what used to be support, right? And so what I'm looking at right now is this area here and what we're doing around that range, right? And you can see we had the nice breakout, the retest, and then the move up. And this was actually a pretty bullish pattern play here, right? And it actually culminated in a pretty nice move. But now we've had sort of a change in sentiment here, right? We had a breakdown, and we lost a key level, and are now in the process of really trying to stabilize. And I think this is a good spot for it to try to stabilize, but I wouldn't get too excited about playing to the long side here because, again, this is reminiscent to what I mentioned on the Dow Jones, where at this point, if we do want to play a bounce to the long side, well, there's a lot of overhead resistance and a lot of potential messiness in this trade because we're gonna encounter a lot of potential resistance at 1250, then again at 1280 at the 200, and then at 13 with the 50 period, and then all the way at 1320 or 30 for the 20 period. So I think at the moment there's a lot of messiness on Freeport-McMoRan as far as trading to the long side. So I don't think that this is really a spot where you want to get too involved playing it to the long side, okay? I think that it's due for a bounce just based off of how quickly it's moved back down to the downside. But I think that this bearish turn of events is not over. So I think the next move is going to be sloppy. And I think it's going to be met with a lot of selling pressure. So for the moment, I'd stay away from this one, Ray, okay? I think if we even take a look at the longer term trend, we can see it's lost a lot of momentum. And at the moment, it's going to need more time testing the 200-period moving average. And I suspect that this is going to be range-bound and just kind of sloppily trading back and forth until it gets enough momentum to get back above all of these moving averages. Okay? All right, Noman, you want to look at Tesla. Tesla just had a poor earnings report, right? And they are at lows, basically. If we take a look at them on the weekly chart, they've lost a very critical level. Actually, this is very important, right? So this is actually a pretty significant move in the longer term. And I'll zoom out a little bit more so you can see what Tesla has done over the course of the last 5 or 6 years now, right? And they were. It's actually kind of funny to me. They were one of the most predictable stocks from 2014 to about 2017. It was very simple. They were trading in a range. Every time they got to the top of the range, they'd sell off. Every time they got to the bottom of the range, they'd just come right back up. And you could tell they always had these clean trend lines, right? And then they finally were able to break past that range. And once they broke past that range, things got a little sloppier. But for the most part, they've basically just traded in a range between 380 and maybe 270 with a couple of sort of moves back below it, but they were quick. Well, they lost that range now, right? And so I think at this point, if I had to guess, I would imagine they're going to come up and retest the top of that range and then roll right back over and head back to the bottom of this major range that they spent quite a bit of time trading in. And I just, that's the assumption I'm taking right now is that they're back in this range, which means they ultimately need to test the bottom of it. But I do think that there's going to be a test of the top before that happens. And I think at that point, that's when we'll really figure out where Tesla is and what it wants to do. Because if it can't break this and sort of trade back in this area, then I think it's heading all the way down to 180. Or sorry, well, 187 or so. But until it does that, I think at this point, yeah, I think it does bounce soon. And we go to the daily chart now and take a look at what's happening through the daily. You can see we had this trend line, and we've just been slowly losing our momentum, and that's what it does. That's what it does constantly, right? That's what it did throughout those 4 or 5 years that we just saw on the weekly chart. But it would always, once it hit the key support level, it would always break this trend and start trading back to the upside. This time it failed, and it failed pretty strongly. So unless it can make this, unless this could turn into a false breakdown where we get a strong move back up and into this area here, then I think that this shows an ultimate failure from Tesla at this 270 level, which means that the next time we get to that level, we should expect it to roll right back over and head back down to a lower area. But again, I think it has clear trend lines, so it's easy to understand what's happening and just follow those trend lines depending on how it behaves at these critical inflection points. But I think that that's the key right now for it. I don't want to get too much into the fundamentals of it. I want to just, usually I pay attention to just the technicals and how it behaves. And I think this name in particular has always done a pretty good job of following the trend lines and following the sentiments that we can see based off of them. And at the moment, this is a clear failure of a very important price point. And so at this point, you have to not trust it, and you have to assume that the next test up, this is going to turn into resistance rather than support. Okay? All right, Ron, you want to look at WP? You're asking, does it look like a buy here? All right, this is a tough one because this is what we were discussing before with the markets, right? Which is this idea of chasing the price action higher. Is this a buy? I have a hard time buying something that's this high. I don't like to chase price action. They're all-time highs. So, I'm assuming this is all-time highs, not just, yeah. All right, so the problem I have with this right now is that at the moment, you've missed this move from 112 to 118, right? That's 6 points. At this point, what's your risk versus your reward? So if you decide to put an arbitrary stop right here, then you're going to get shaken out as this comes down. And if it comes down and fills the gap, and it could still be a very bullish play where it just kind of comes back, fills the gap, and then breaks out. And that means you would have had to hold at 6 points just for the idea of it going higher. And I think obviously when you see something like this, it's chances are it's going to continue climbing, right? I mean, I don't think that's really in doubt. This has been a very strong move, and despite the only time it really had any weakness was when the entire market was in a free fall at the end of last year. Other than that, it's really never really had a strong sell-off. So overall, I would say this probably has better days in the future, and it's probably going to continue going up. But is it a good trade here? I don't think so. And I don't think so just because I don't think this is good risk reward. And I think that you kind of missed the move already. Now, it might have been hard to get that move because it was a gap up. Was this an earnings gap up, or was it just a strong price move? Oh, here's another reason to stay away from it right now. It has earnings. It has earnings tomorrow morning. Okay, and it moves. It can move as much as 8%, right? So far, out of the last 5 quarters that it's been around, it's shown them the propensity to move between 5 to 8%, right? So, I would wait. Yeah, I would wait. Let's see what happens after earnings. Maybe you get a move back down. Maybe it fills the gap off of an earnings move down. If it has an earnings move up, then what can you do, right? But I mean, you don't want to take extra risks just because you like a name. Names like this, they always have these consolidation patterns, and that's when you go ahead and get them back to the long side. But I do like this name, and I would put it on my watch list and just leave it and wait for the next wait for the next move. Ultimately that's what you want to do, right? You want to control your risk and your reward because that's the only thing you can't control. Okay, but it's a nice name. All right, guys. Thank you. Those of you, thanks for attending. I appreciate you guys coming in. I appreciate the participation from those of you that had chart requests, and I hope you guys got something out of it. Um, like I've said before, if you guys are interested in what we see, I know most of you guys are regulars, so obviously you like what I say out of what I see out of the markets, and you like my advice as far as how to trade. If you guys are interested in more, as usual, just go ahead and visit me at patreon.com. Um, I put a lot of stuff on there, and the more people that are on there, the more I feel like validated by it, and the more posts I would probably put anyway. So if you guys want to go ahead and visit there, I'd love to see more people visiting regularly. And I have a lot of good trade ideas, and a lot of times, a lot of the theories and a lot of the ideas that we discuss in these Wednesday webinars, I go ahead and continue on with them and explore them in more detail when I go ahead and put my trade ideas on there. So make sure you go in there and take a look at it. Keep in mind, I also do mentoring for those of you guys that are having trouble in a market like this, or having trouble just in structuring your plays. Sometimes there's traders that just need one little turn, to be able to become successful, become profitable. And sometimes it's just a matter of fixing one or two little things with your trading process. So if you have stuff like that, if you have questions, or if you want to even just have one or two mentoring sessions, it doesn't have to be a thing where you spend 2 months working with me. It could be where you just want, maybe a 2 1-hour sessions or something to kind of go over your trading process and analyze it. Feel free to ask me. Message me on Twitter, message me, email me, stockdarts@gmail.com, and we can work out just a couple of sessions to kind of go through your trading process and see if we can clean it up a little bit. I've done that with a lot of traders, and it's worked out really well. Or if you want something more substantial like learning options, or really getting in depth in technical analysis, feel free to ask. That's kind of what I'm here for. I enjoy educating traders a lot more than I do even trading, and I love trading. So go ahead and visit there. And as usual, if you guys ever have any questions, you can ask me on Patreon, you can email me, you can ask me on Twitter. Other than that, hope you guys have a good rest of this week. Keep an eye on what we do with FOMC today, and we'll meet again next Wednesday. Thank you, Denise. You too.